This is the current federal tax developments for January the 12th, 2026. We have a pretty heavy agenda running today. We're going to cover the immediate protocols that are going to be coming up for the 2026 filing season. We're going to talk about a significant revocation of exempt status, substantiation failures for charitable contributions, and FBAR penalty develops in the Second Circuit, and a taxpayer winning regarding premium tax credit on a procedural issue. So, at Zollars, coming to hear from Phoenix, let's go ahead and take a look at this week's roadmap, shall we say. So, we're going to start with the IRS's announcement regarding the filing season, which begins later this month. Then we'll move into the case law, specifically looking at a 501c3 operational test failure for an organization, right? A Section 170 substantiation disaster, a solidification of the willfulness standard in another circuit for penalties under the foreign bank account reporting rules, and finally, a procedural check on the IRS regarding summary assessments. So let's go ahead and we're going to start out with the services announcement found on the Internal Revenue Service news release, IR 2026-02, issued on January the 8th, 2026, entitled The IRS Announces First Day of 2026 Filing Season, Online Tools and Resources Help with Tax Filing. This is the official announcement of the start of the filing season. And as expected, the One Big Beautiful Bill is driving a lot of the narrative this year. And the commissioner, who's also the Treasury Secretary, and the service are emphasizing the systems are updated. But as we know with experience from major legislation, we're going to have to watch for when forms will truly become available for electronic filing, both at the IRS level and in our own tax software. So let's start out with the fact that we've got to mark our calendars for Monday, January the 26th, 2026. This will be the official opening for electronic filing of returns. The deadline, of course, remains April 15th of 2026. And as we all know, that's really our deadline, only in the sense of going to be throwing in a lot of extensions about then. So we always have to deal with that. Now, the IRS is projecting 164 million returns to be filed this year. And we also know that the IRS announced here as well that Free File is going to open on January the 9th for qualified taxpayers. Now, obviously, that's kind of the interesting aside, is that opens January 9th, but the real start date's not till the 26th. So they're just going to be doing what everybody else is doing, which is if you have any returns that you manage to get finished this early, which is difficult, but if you do, basically you just got to kind of hold them until they actually will start accepting them, or your service, your tax software vendor starts holding them, right? So anyway, for us, we're looking at the 26th is where we start getting into filing things online and working with it. Now, the major workflow change this year we're going to have is going to involve all of the tax cuts for working families. If you've not looked at the draft Form 1040 for 2026, which last time I checked was still in draft form, not officially released yet, but you will notice there's a new Schedule 1A for the 2025 tax year. These are different issues. This is where the four new provisions, essentially, the no tax on tip, no tax on overtime, no tax on car interest, and the special senior deduction, they will all go on this form. They do not go into other income as a negative adjustment. They do not go into adjustments, as an adjustment. As I've mentioned multiple times, and Schedule 1A makes very clear, when you follow it to the draft Form 1040, these are all used in computing taxable income. They're not used in computing adjusted gross income. So you still get to claim them even if you don't itemize, right? And your client's does not need to itemize to get any one of those four, but it won't reduce AGI. So again, it's not going to have an impact on things like the IRMA calculation for Medicare, right? Issues related to, qualifications for financial aid for students, that kind of thing. None of that will be impacted by these four things, right? And this is a dedicated schedule for these exclusions and deductions. And essentially, it's going to kind of push it where it needs to go. This is one of those things. So if you find again, and it's becoming really tough, I even have to battle with Gemini when I'm doing things or when I'm using even Notebook LM, this sneaks into. for various reasons, it'll keep wanting to call something above the line. It's like none of these are above the line. They're all below the line, And by the way, when I asked Gemini to justify why it kept doing it, it then referred me to an article by a large law firm and an article by a regional CPA firm, both of which have it referred to as above the line. It's like, yeah, it's like they're getting it wrong, so I can get it wrong, is kind of the impression that we got from Gemini. We'll see there. Okay, now, what goes on Schedule 1A, as we know? We have the exclusion for tips and overtime pay, right? New deduction for car loan interest and the enhanced senior deduction. As I mentioned, these are not deductions that go into, computation of AGI. They're not above the line deductions. And, make sure you understand that, because I still run into people that don't quite get that. And I'm concerned that some people may have done some planning for either tax-related items depending on the AGI or things like those outside things, financial aid, IRMA calculations for Medicare Part B and Part D premiums, and have done those calculations assuming these will reduce AGI, and they won't. That's going to be one of those issues here. We got to make sure that everybody in our staff is up to speed on looking for this. Again, clients don't necessarily know they have to provide it. And yes, we know some are organized, so we probably mentioned these things. But I guarantee you, the client's not going to read that. So you need to make sure you pick these things up, and find out about those issues and ask clients about, did you incur any of these items? Like something like overtime pay, that may not, you're not going to necessarily notice that on W-2. Remember, the employers are not required to put anything in Box 14 this year explaining overtime. They're encouraged to do so, but encouraged and doing it, different issue. I saw an article in Tax Notes today this week where, basically legal counsel was suggesting that, they weren't sure they would ever advise a client to actually voluntarily put that on there because they might have liability if they got it wrong. As long, if you think that way, you're going to see there's going to be some employers that simply aren't going to provide that. So you're going to need to be aware and looking for it. There are two other administrative items that were brought up also in the news release. This is a news release the IRS is going to use to announce the whole tax season bit. They want to remind you about the Trump accounts for children, right? The guidance is still very, very thin right now. All we know is that we're going to be able to set this stuff up, set things up for the accounts. We don't really know any of these issues. But the IRS is directing everybody to trumpaccounts.gov. Now, the only problem with trumpaccounts.gov right now is all you really can do there is, sign up for email that'll tell you when it's going to actually tell you how to really do the sign up. We know about the form. Now, when that form goes live will be a different question. By the way, that's going to be the big problem about all of these, January 26 dates. I don't expect that form to be ready January 26th because I don't think they have enough of the back end set up to be able to commit to, start accumulating that data. So I am expecting some issues coming up. The other big thing we have this year, don't forget, because the executive orders on modernizing payments, the IRS is phasing out paper checks. At the end of last filing season, extended filing season, right? Remember at September 30 of last year, the IRS announced no more paper checks for refunds. Now, at some point, they're going to pull the trigger on no paper checks for payments. So if you have clients who traditionally refuse direct deposit, this year, there's no question for that. You're going to have to tell them, guys, if you don't do that right now, you're getting debit cards or something of that sort, which I doubt they'll find better than, getting the direct deposit. As I always told clients who said, I don't want direct deposit, I don't want the IRS to know my bank account number. I said, if you ever written them a check to pay a tax, they know your bank account number. Everything they need to hit your bank account and withdraw funds is right there. So if you believe they're going to reach in your bank account and take the money, they're already pretty much able to do that. So that's nothing you're giving them by doing that one, right? You need to have that conversation, though, with clients this year when they bring stuff in. In essence, you probably should ask, all of your staff should be looking to see, is there a client here we don't have bank account information on? And if we don't, somebody needs to contact them early on and say, look, your return may simply not be able to be filed unless you have that stuff, or you may end up getting things like debit cards you might not want. So you got to kind of have that conversation. There's a lot of stuff to reach out to clients this year Like I say, if you believe they're really going to just read your organizer, first thing is you obviously have never been through a tax season. Secondly, yeah, we all know they're not going to do that. We know that they will, some of them will just bring it back to us, nice, sealed up in the envelope we send out to them in. I mean, we know how that works. So make sure you know what to talk about your clients with in this regard. Now, on the information reporting front, we've got some new stuff this year. We have the Form 1099-DA for digital assets. That is live and will be received. You have to prepare for the reconciliation headache this year of matching this against trading logs, because this year they're not required to give you any basis, even if they know it. I'm going to hope that most of the exchanges, right, basically we go about, the places you sign up, the Coinbases, etc., will provide reports with basis if they have it, but they don't have to. And all you may know is there's going to be sales reported with no information about basis. And your client's got to realize that we need basis numbers. And if they don't report that stuff, or say they don't give it to us, which I know we're going to have some clients who do that. But the clients that do that, you're going to get very worried about how many trades they have in earlier years they never told anybody about. Now, you just got to point out the 1099-DA, that one is reported to the IRS. So you need to be aware that they're going to assume zero basis, short-term capital gain, or maybe just ordinary income. It's tough to know which side they'll do there. Probably ordinary income. If you don't tell them one way or the other, the reason for ordinary income is they're going to, they're just going to assume that it was, received as payment or something, that therefore there's a chunk of unreported ordinary income. And so while the basis will be equal to the selling price will be considered as ordinary income, and why not pick up some self-employment tax on it as well. So, yeah, tell clients, do not ignore the 1099-DA. Also, 1099-Ks, we still have that coming in here. These are still a bit of a focus. They may come out. Yes, I know the One Big Beautiful Bill Act did back off the reporting requirements of 1099-Ks, but I suspect a lot of companies will just send them out now, having sent them out before. They're just going to send them out. So you may still get those 1099-Ks that you don't really need. So that'll be part of it there. And also remind your clients and everybody here, income reporting is required. The mere fact you didn't get one of those does not mean you don't report it. You got a client, who has done sales of items on eBay or wherever they might be, where the 1099-K could come out. The mere fact you don't get a 1099-K doesn't mean you don't have to report it. And most importantly, if I know you've got that income, I either have to fire you or we need to report it, right? One or the other. I mean, as I will tell anybody, I prepare a whole lot of returns. I am not going to take that level of risk because I have hundreds. You've got a single 1040 you're at risk for, client. I got hundreds that I'm at risk for. And any of them get picked, I'm out of business, right? If I get caught cheating at that level, and just ignoring things. So I'm not putting my stuff at risk for that. And for those of you who are watching the video of this, which we have up on, if you're watching the video, some state societies post that. And we also have it up for you on, Vimeo, right, on our website. So you can find it there. It even sits on YouTube if you really want to go there. We have here just a quick summary of this, our key due dates here. The filing season opens on the 26th. The IRS reminds you about April 15th, in case you forgot it. 164 million returns. The IRS discusses briefly the new deductions. Remind us we have to start thinking about the Trump accounts, especially for the kids born in 2025. Though don't forget the Michael Dell donation. So there's $250 that somehow is going to be available to children who are, 10 years and younger, but weren't born in 25. So we can get that. And this does have place. The IRS tells people where they can find their free help and their online tools. So, hey, all of that's together as we have this. And yes, this infographic was put together, as it says down the corner of the screen, by Notebook LM. It just basically, I gave it the post and said, hey, guys, give me a nice little summary of this. So we can do it on one screen. So we have this nice little infographic. Kind of useful. Next up, we're going to move to case law. We have a tax court memorandum decision regarding the revocation of exempt status. This is the Milk Saving Starving Children Foundation case. It's a textbook example of how not to operate a 501c3. This is Tax Court Memorandum 2026-1. This is issued on January the 6th of 2026. So in this case, what happens is the IRS revoked the exempt status of this organization, and the tax court sustained it via summary judgment. Right? The core issue here is what's known in tax-exempt functions as the operational test. Remember, the determination letter is just saying the organizational hurdle. It says your organization, as its documentation shows, and as you have explained it in your application, that it would qualify as exempt. But just like we have with qualified plans, you have to both be exempt in the term of, or qualify in the term of what your documents say and what you plan to do. But then we have to check and make sure you actually follow through and you're doing things operationally that don't violate the law. So to keep the tax-exempt 501c3 status to which charitable contribution deductions can be made, and for which there'll be no income taxes imposed on this organization, you must operate it exclusively for exempt purposes. That's the key rule in the code. Right? Now, exclusively is not absolute, but as we'll discover, we're going to have a problem as any significant activity that is not related to the exempt organization. Now, this organization started with, on paper, a noble mission, buying milk for starving children. However, they never really bought much of that milk, right? The facts on the ground were very, very different. What they did was basically they bought property and opened up Cafe Benet, right? Sorry, my French is bad in that case. And I forget, and I know I knew how to pronounce this properly once, but we'll get there. This was a cash business. It was a coffee, right? They're in competitions with Starbucks. They actually didn't do very well, but they were in competition with that. And they leased office space to pizza shops. Well, I rephrase that. According to reported things on their 990s, they didn't do very well versus Starbucks. Of course, it was a cash business. I assume the IRS may be a little suspicious that maybe did a bit better than was reported. And in essence, they did very, very little with milk. And in fact, by 2011, the actual distribution of milk had completely stopped. They hadn't done it for years, right up until they got the IRS exam going. Now, when the IRS began looking at the 2018 tax years, the financials were at best damning. I think that's the best way to phrase it, right? There was rental income of $6,000. There was a fundraiser of $13,000, and there were cafe sales, right? But the expenditures, money went out the door from this organization for mortgage, insurance, and loans to the founder. The amount of spending they actually did on anything charitable that year was zero. No funds were expended for their charitable purpose at all for the entire year. And they only restarted shipping milk after the audit began. And the court points out that's reactionary, right? You're just simply reacting to the situation and going, "Oh, we need to do this," right? So we're going to try to start doing it now and hope they ignore the fact that from 2011 all the way through when this exam got started, we never did any of this. The court's not going to ignore that fact. I hate to tell them that. That's going to be kind of bad, right? So the legal standard here relies on what's known as the Better Business Bureau rule for to be an exempt org. The presence of a single substantial, non-exempt purpose destroys the exemption, regardless of how many other good things the entity does. The fact that you can file a 990T for unrelated business income tax does not mean that you can have everything in the organization be unrelated business income. Not how this works, right? That's meant basically for an insubstantial, not substantial transaction, right? That's not part of your exempt purpose that operates like a business. Commercial activity is allowed to that minimal event, but it must further the exempt purpose and, it can't be the main thing we're doing here, right? Commercial activity was the primary purpose of this organization. They were coffee and renting, rental real estate and coffee. That's not getting milk to starving children, despite the name of the organization, right? Um, these operations were not a means to an end; they were the end in and of itself. Because again, remember, money was then being loaned to the founder of the organization. So essentially, he just claimed he owed him money, which also is a really, really bad look. We won't even get into the problems that cause. That by itself can kill your exemption. So we'll get there, right? That's a little different. So here are our holdings and our key takeaways from this. The takeaway is to monitor any nonprofit clients for mission drift. Now, this is mission drift. This thing drifted so far. This is like sailing from London to New York and somehow, ending up in Hong Kong. That's how far we drifted, right? Off of our mission, shall we say, right? The intentions stated in your Form 1023 are irrelevant. If your actual operations shift to commercial real estate or retail without some direct causal link to the charitable mission, which there's none here, right? And by the way, it's not really usually enough to say, well, I'm earning this money and then we're just going to go send it to, right, for this. There have been a couple of attempts we've covered over the years of people trying to do that and claiming that they were a charitable organization because even though they're pulling salaries and stuff out, right, because they were selling product, but our profit's going to go to run this. It's like, it's not going to make it work necessarily as well. You have to advise clients you can't fix a bad year by rushing donations once the IRS shows up. When the IRS shows up, they're examining a prior year. That prior year is fixed. Whatever you need to do need to be done then. You can't wait till they show up. I've been doing this for years. The IRS never said anything. That's true. This organization's been doing this for years. The IRS never said anything. Right up until they did. The IRS does not show up and audit every business and every organization every year. I find our clients hilariously, seem to think that the mere fact the IRS didn't audit you means they approved you, everything you did. No. And certainly not in a not-for-profit situation. So kind of our overall graphical summary for this one is how a nonprofit organization lost its exempt status, right? We talk about the promise they made to distribute powdered milk to, wholesale. And there was some initial charitable activity when they first founded in 2001. It wasn't great, but at least it was something, right? I mean, it was infinitely more than what they did in 2011. That's how we'd phrase it. But the reality was, very quickly after they started operations, they shifted to commercial business, and they had just done nothing, right? For it, literally after 2001, they basically milk donations ceased entirely. Some other things happened, but the milk donations were gone. Their theoretical purpose for existing after 2001. And they really, I was just saying 2011, they kept going. 2001, they had it, but they kept going. And only resumed when the exam got in play, right? When the 2018 exam, IRS began its exam in 2019 on 2018, suddenly they started doing this. The financial numbers are horrendous in this case, right? We had total income of $26,447 for 2018. That was reported on the 990. We had absolutely nothing spent for charity, but the officer took out essentially, over a third of what it took in revenue went to the officer as a, quote, loan. So the court simply said, you failed the operational test. You can't just say we're going to be charitable and then once the IRS grants you the letter, say, oh, that's great, we're done. You're not done. You got to stay in and you got to actually keep operating in that charitable function. Next, we have the case of Gibson versus Commissioner, right? This is a summary opinion. It's not binding precedent, but it's an excellent refresher on the substantiation ties, the ties and the substantiation rules and the various tiers that they have under Section 670. Now, at this case, it involved a nearly $190,000 deduction. As a starting point, I'll say if you claim $190,000 worth of non-cash contributions on your 1040, unless you're Elon Musk, right? We're going to have some really, really huge income where that might be insubstantial. It's going to get attention real quick. Right. Well, this is TC Summary Opinion 2026-1 issued on January the 6th. So what went on in Gibson v. Commissioner, and why did they have such a problem? Now, this case, the taxpayers donated high-end cycling apparel, right? And they claimed they had a cost base over $250,000 and a fair market value of $188,000. Now, they claimed that what they received was a gift. And they would then try to use that, say, well, we can't really substantiate the basis for any of these items because it was a gift. And let's say at a certain point, we'll talk about the tiers here. For non-cash contributions, you must provide them with the basis. And, the IRS push goes to shove, and this is a real problem with all these documentation rules. When push comes to shove, the rule is generally either have it, show it, prove it, or lose the deduction, right? This is how this thing works, right? Now, in this case, the IRS disallowed the entire deduction on exam because the taxpayers failed to substantiate the basis and also failed to produce a qualified appraisal that was attached to the return. These are two key requirements when you're going to claim, a $188,563 non-cash charitable contribution on your return. You have to be able to meet those two. So let's go over the rules right now, because this is really important, right? For any contributions over $250, you need to have a contemporaneous written acknowledgement. And the taxpayer had that. Contemporaneous written acknowledgement is from the charity, right? A document written, meaning in writing, acknowledging the contribution, which does mean, we had a case a couple of years ago where there was tried to claim that something on their website amounted to an acknowledgement. In this case, it was for a, basically, one of those, where we have the, now I can't even get the name right. Isn't this great? Where we have the funds, where you specify where you'd like it. You advise them, donor advised funds. See, I knew I'd get it right. It's always great. You can think of the acronym, but you can't get it right off the top of your tip of your tongue. Donor advised funds, one of the things they have to have in the CWA for those, which is unique to them, is that, the charity has the right to determine where things go. They said that was on our website. The court said, no, you can't acknowledge something. You can't acknowledge a gift, and you can't acknowledge this fact until after the donation is made, that this donation was made subject to that requirement. Okay, but so that's it. So it needs to be in writing, needs to be after the gift was given, but you have to have it in your hands before the return is filed. Fail any of those and it's disallowed. That means you cannot get a CWA when the agent shows up for the exam. If there's some flaw with your CWA, it's too late to get it fixed. That goes back years ago to earlier case law, where simply even for a $26,000, I think it was $26,000 cash contribution, was the one at hand in that case involving the church, where they had just forgotten to say no goods or services were provided in exchange for this gift, except the intangible religious benefit. That was missing. They issued a new one when the exam started. Sorry, you lose this. We are super picky here. Understand this. And the IRS wins on these, right? Once you cross more than $500 in non-cash contributions, you have to verify for a non-cash contribution under Regulation 1.170A13. You have to require you to verify the manner of acquisition, the date of acquisition, and your cost basis. Okay. That's going to be their problem here. For each donation, they couldn't verify the basis of all these items they were giving. $188,000 worth of donations, that's not one piece of clothes, okay? That's not one article of clothing. That wasn't what we got here. It was a bunch, right? And on top of that, we go on, and if a contribution is more than $5,000, the bar is even higher. We have to have a qualified appraisal. An appraisal summary must be attached to the return and specific records, right? The standard here is strict compliance, and there's very little wiggle room for substantial compliance in higher dollar non-cash contributions. There is some, as we'll discover, a little bit, but not much. Really need strict compliance. There are parts, any part referenced in the code you must strictly comply with. Any parts referenced in the regulation, you theoretically can get by with substantial compliance, but you're going to have to be really, really close there. So the problem here is Section 170F11 has most of these requirements. And one of these is we have to have qualified appraisal, right? One of those backgrounds are there. And the summary has to be attached to the return. Okay. Now, the taxpayers' defenses were weak and the court didn't go along with it. They failed totally. He had claimed the items were gifts from a family member and that it was, in his words, impossible to get the basis from the donor. Now, the court was, it said it wasn't clear whether they really meant gifted or inherited, but said it didn't really matter. If you can't prove basis, you can't take the deduction. Right? That's basically going to be true. It's also going to be true, to be totally honest. You're going to have a problem with it whenever you have a gift and you need basis for something. You've got to be able to prove basis. Now, in cases other than this one, because this is when Congress got really mad and really strict, you might have a better chance of arguing, a Cohen defense and saying, well, there's got to be something. But that still requires a reasonable method of estimating. And, never were they claiming that, just simply couldn't get it. So they guessed. And they tried to submit their appraisal during audit. But they also, they never proved the appraiser was qualified under the rules. And remember, we talked about that. We talked about the Metropolitan Museum of Art donation back last year. It's really weird calling 25 last year now, but it is last year. Back last year, we talked about that donation to the Charitable, to the Metropolitan Museum of Art, where they, had a contribution that had an appraisal that was ruled to be not a qualified appraisal, and one of the issues they had there was the appraiser was not qualified, right? It couldn't have been the corporation, and the person that signed, she didn't have the background necessary. Again, none of that was shown about this appraisal, which was supposed to have been information about this with the return, which they missed that too. Basically, we're losing this. We're just lost entirely. It's not going to work, right? So this case, while a contemporaneous written acknowledgement is absolutely required, it's not enough when we talk about certain contributions, right? So that, the 170F8 thing is simply not good enough. You're going to need to have something better. In this case, it failed 170F11's requirements for this non-cash contribution. If a client comes in the door with a mass donation of gifted property and can't tell you what the paid for it, that deduction is in jeopardy. Right? You're going to have to come up with some reasonable way of getting a basis number that you can at least argue for instead of just saying it's impossible to get anything for it. There's no way to get it. It can't be done. So tough luck. Remember, the other big reason why you need basis, unless it's long-term capital gain property, again, they really didn't establish when they got this stuff. Your deduction is limited to your basis in the property unless you can show us long-term capital gain. That means when did you get it? And it wasn't held for inventory. All those other things were involved, right? I mean, why in the world did people gift you, $180,000 worth of this stuff? The court was somewhat concerned that maybe you were thinking of selling, basically you got inventory and you're thinking of selling. We don't know in that realm. And also don't just accept an appraisal report. We know the qualified appraiser rules are there. And I've seen a couple of these cases where charitable deductions have been thrown out through the tax court where they've gone to a CPA firm, in some cases, a large CPA firm, a large regional firm or a national firm. And it appears they never looked at the appraisal and saw problems, which the tax court found instantly. I mean, you're not an appraiser, but you do know how to read the reg about what an appraisal should have and what qualifications they need to show. and what information should be there, you want to review the report and say, hey, look, we need credentials. Qualifications have to be in the report for this appraiser. There's none here. They need to put that in the report in order for us to have any shot of defending that appraisal report. That's what makes it important. So, again, if you're watching the video, our nice little graphic here to go over this, the anatomy of a denied charitable contribution from the tax court, right? We had 188,563 deduction claim for all of these, bike, shall we say, apparel. They were acquired by gift. They were valued by appraisal, right? They claimed, and actually a very exact number, $51,417 worth of bases. But they never actually, when they listed out what they gave, they didn't put down for each one. So obviously that basis number, which probably hurt you as well. Remember, there's a reason why under Statements and Standards for Tax Services, applicable to CPAs, that we're told that when you're estimating, when you have to use estimated numbers, you cannot use $251,417. It doesn't say that exactly. It says, you're not supposed to use numbers that suggest you have information you don't. That suggests you have information you don't have. It would have been better to say 250,000 even. At least then that would have put the IRS on, would have given the IRS a clue that this is a rounded number basis, as opposed to the old thing, right? And we also had an appraisal that was submitted, right, during the IRS exam, not with the original return. Ruling, deduction was totally denied. First failure, there was no proof of basis or when they acquired this stuff, how they acquired it. That's required. You're over $500. That's required. Number two, the appraisal was not proven to be a qualified appraisal conducted by a qualified appraiser. And that's what we got. Once we got over 5,000, we had to get that to come into play, which we didn't in this case. And remember, the burden rests on the taxpayer. It's up to the IRS to show, hey, these numbers aren't right. It's up to the taxpayer to show these numbers are correct, and they're allowed to take the deduction. And the appraiser was qualified. They met all the requirements. In this case, the taxpayer did none of that. Not surprisingly, the taxpayer lost the entire deduction. So now let's move on to something a little bit different. This goes on the Second Circuit Court of Appeals and the FBAR reports. The Reyes case is significant because it solidifies judicial consensus among a large number of circuit courts of appeals on what constitutes willfulness for civil penalties. In fact, the Second Circuit in its analysis will conclude that no circuit actually holds differently than they're holding. Now, whether specifically the Fifth Circuit would agree, I'm a little more open to question on, but it's their position. So this is the Second Circuit Court of Appeals, docket number 242333, and the decision was handed down on January the 7th of 2026. So the Second Circuit has now joined the 3rd, 4th, 6th, 9th, 11th, and federal circuits, that's quite a few, regarding what is willfulness for purposes of the FBAR penalties. And the holding is very clear from their standpoint. Willfulness includes reckless disregard, reckless conduct in attempting to, comply with the rules, right? You don't need to prove the taxpayer actually knew that, they had this specific reporting requirement which they failed to fulfill, or they had even evil intent in doing so. Reckless disregard. You didn't take the steps a reasonable person would have taken to figure out if I have some reporting I should be doing on this, right? Is enough for the 50% penalty. And the court also held that a 6% late payment penalty, which is kind of separate outside the tax code, was mandatory, in that realm. So we'll talk about that too. That was a second holding of the case. So facts here, bad facts. They had $2 million in a Swiss bank account. Okay. Nothing wrong with that. You do have to report it, but, nothing wrong with that. And you have to report the income on it. Well, did they really do that? Well, 75 to 90% over the time period in that account was of totally liquid assets, could be used for spending. And they spent it. They spent parts of it. Now, they used a hold mail service. So they had their, in essence, statements and everything mailed to a hold mail service in Spain. No mail came to the U.S. about these accounts, right? And so they, I should say, no, actually, credit cards were ones that went to Spain. They had credit cards linked to the funds, but those went to Spain. And on Schedule B, the bottom of Schedule B, they had, on there where you report your interest income and dividend income. And if Schedule B is there, you've got the FBAR questions on the bottom of the page. They checked no to the answers there. No, we have no interest in a foreign bank account. We're not required to follow the FBARs, which was incorrect, shall we say. And so the IRS went after basically the willfulness penalty, which is half the balance of the account. Yeah, that's expensive. The standard for willfulness is objective, right? Would a reasonable person have investigated, right? In this case. And it says the court looks at this standard as it's an unjustifiably high risk of harm. In this case, either the risk is known or it's so obvious that it should be known. And the should be known is a catch here because they're obviously going to say, well, I didn't know. I didn't know. I had all this money sitting in the bank account, but I didn't know, and I had income even on it. I didn't know I should have reported that to the U.S. government. Yeah. Now, this is a different standard than criminal, right? In criminal cases, you have to show actual knowledge. If you're going to try to put them in jail for this or impose criminal sanctions on them, got to do this. But the FBAR penalty is a civil penalty. Civil penalties, willfulness is merely you should have known, right? Would a reasonable person have investigated? If that risk of non-compliance is unjustifiably high and is so obvious it should be known, it is willful. That is what's called the Safeco standard. Right? Again, case law. You'll find that written up in our written discussion. And also just read the case, you'll get it. It's there, the Safeco standard. Now, what evidence established that, Mr. Reyes, well, Mr. and Mrs. Reyes, I should say, were reckless? Well, the court referred to a smoking gun in this case. It was a bank form where the taxpayer explicitly refused to authorize W-9 disclosure to the IRS. You're presented with a form saying, do you want us to disclose this to the IRS? Right? You can't sign that form, right, and then claim ignorance that you didn't look at anything related to it. What they're trying to say is they were ignorant, right? See no evil, right? See no evil, hear no evil, etc. All of that line. They're claiming, well, I just didn't know. The court says at that point, it becomes willful ignorance, right? This is your problem. And the court reiterated something that the court has said multiple times. Signing a Form 1040 with Schedule B check no is in itself a sign of risk that cannot be ignored. I didn't read my return is never a defense. That doesn't work. If your clients are just sitting there covering their eyes, the only thing they want to know is where do I sign and how big's my refund? That client will not be able to claim that they just, that was on, I didn't know, I didn't read that. You have to read it. You have a responsibility, client, any taxpayer has a responsibility to read the return. If you're not doing that, that is reckless conduct. And while, yes, you could probably still civilly sue your preparer, you might be able to get a jury and a local court to agree that the preparer should have told you this stuff. Maybe you'll get some damages from them. But as far as the IRS collecting damages from you directly in federal court, sorry, you can't punt this off by not reading what was the form, reading the form and just seeing. No, obviously we don't expect you to understand the whole detailed tax law. Don't expect to understand, totally complex stuff. There's a reason why you have a professional working with you. We do expect you to kind of look at it and ask questions, Do you have a bank account, located outside the United States? I mean, that's a yes, no, it's not that tough to figure out. And, you just kind of ignored that. Now, they also decided something that's in a different section of the code. This is under Title 21 of the U.S. Code, Section 3717. There is a 6% per year penalty on debts past due greater than 90 days, the United States Treasury. In this case, they argued the court should lower the interest penalty. The Circuit said no. Under the Federal Claims Correction Act, the agency sets the rate at 6%. The court had no authority to lower it. The IRS could have charged a lower rate, but could have set a lower rate, and when they set up their rules, right? But once that was set, the district court, as long as the penalty applies, it's got to be that rate. That's not the court's to deal with. So, summarizing again, reckless disregard equals willful failure when we're looking at an FBAR filing, right? Now, in this case, right, reckless disregard itself is a willful violation. Civil penalties, we do not have, the court, IRS does not have to show you knew you had to do it. They just have to show you willful. Remember, so the test is not showing you actually did know, it's showing whether you should have known, right? In that regard. It's an objective standard. Merely testifying, I don't know about that, is not going to get you there. I didn't willfully do it. We're looking for conduct. And taking steps like this taxpayer did, I got news for you. That conduct will attempt to be used as well if they're doing a criminal case. They would use that as part of showing that you were totally aware of this. Why would you have done the things you did that kept any mail from coming to the U.S. unless you were trying to avoid, kept any reporting going to the IRS unless you were trying to avoid? You're trying to basically evade tax. Let's be honest. That's going to be the argument that the prosecutor is going to make. So, what was reckless? Concealing the account's existence, the steps they did toward that. Ignoring the direct question, they're on the Schedule B, and failing to inform their accountant about this thing. You might ask your professional. Now, here's the catch. I'm going to tell you, everybody listening here, because this is aimed at professionals, this whole broadcast. If you're not a professional, fine, you can listen. But I'm aiming this at the professionals because that's what's key here. You need to realize this is a two-way street. Maybe even for some of you listening who aren't pros, this is a two-way street. You, as the client, as the party going there, what the court's telling you here is you have an obligation to inform your advisor of everything that you believe has any chance of being relevant. I would tell the advisor, though, is you probably need to check. I've said this multiple times. If the client has ignored every single question on your organizer, they never answer because they never opened the envelope. You've got to go back and ask them specifically for things like this, saying, we need to have some sort of assurance you don't have this. We need assurance of this. We need assurance of this. In essence, there's the same reason why your doctor's not seeing you unless you fill in that questionnaire. We need to know because there's stuff we should know and stuff you should tell us, and we don't want you suing us later claiming, why didn't you ask me about this? Yep, that's fine, because if it turns out the answer is yes, I'll give the blunt answer. It turns out if the answer was yes, you have this account, if that had been the answer to the question I just asked you, then you would have sued. Then if you got caught, you would have come back and you would have been complaining and filing something against me saying, why didn't you ask me this? That's why. And if you get caught, if you're the outsider, you're the client, and you get caught this way, then the court's going to say, why didn't you tell your advisor about this? It's important. If you have clients, basically with offshore accounts using hold mail services who have historically checked no on Schedule B, they're sitting on a willfulness landmine. Clients need to understand that if they don't deal with this stuff, and they will most often play hide it from the accountant as well, because they'll realize you probably will tell them you have to report it. They don't want that answer. That's what's called staying willfully ignorant. That is part of willful ignorance. You're going to get that. So what happened here is there was a $420,051 penalty per person because, again, they're a married couple, but there's not really the FBAR stuff is not truly joint, so it applies to each one of them. We split it up for each of them because each had an interesting account. And there's a 6% late payment penalty, and that then runs for every year they didn't pay the $420,051. As you can imagine, they're writing a pretty big check. Not good. Okay. Our final case today is a win for the good guys. Yay. Okay. It's a procedural win for the taxpayers regarding premium tax credit definition of efficiency. The IRS fouls this case up. They foul this whole thing up. Their foul up means that the taxpayers were able to walk away from having to pay back over $20,000 in advance premium tax credit because the IRS didn't pay attention to the code. This is Walker v. Commissioner, Tax Remand Decision 2026-4, came out on January the 8th. As I say, look, the taxpayers, yeah, you can say they shouldn't have won. Well, yeah, had the IRS done this right, there is no question the Walkers would have had to pay over $20,000. But the IRS has got to do it correctly, just like your client who, let's say, hasn't filed a return in 6 years and then whines about not getting his refund back from 6 years ago. Well, you're not getting a refund back because you screwed up, right? You screwed up procedurally. Procedural screw-ups run both ways. And this one worked in the taxpayer's favor. The IRS was the one that screwed it up. Okay. The issue here is the validity of a summary assessment by the IRS, where the IRS just goes directly to assessing the tax. No 90-day letter, no chance for the taxpayers to challenge it, okay, in this realm. Now, this is a taxpayer who got an advance premium tax credit for the year in question. They filed the return, but they omitted Form 8962, the PTC reconciliation. IRS has a 1099-A reporting, basically, reporting that they had gotten not only bought their insurance on the exchange, but had gotten advanced premium credits from the exchange. They're looking for the reconciliation, which is required. In response to that letter, the IRS asked about, the taxpayer, sent in a reconciliation form. And that form, they sent in just the 8962, and it did show that, they had received 20,000 plus because they went over 400 times the poverty level. Remember going back to that rule this year? So that meant there was no minimum amount, right, of any repayment, maximum they had because they were over 400%. And there was also, they didn't qualify. Once you go $1 over 400% of the, 400% of the poverty line, the poverty line, you have to pay back every dollar, that you got because you qualify for zero. So they might have qualified for, let's say, had they been able to use it. Let's say just before that level, they might have qualified for 15,000, let's say, or even 20,000 of credit. Let's say they qualified for the whole thing. Once they went $1 over, they qualified for none. Remember, there's a reason why back before we had before we changed the rule temporarily, why you would have clients that would come in, have this problem, and you'd be scrambling to see if they were covered by a pension plan, profit sharing plan, retirement plan at work. And if they weren't, then you'd go back and you'd simply say if they could make a deductible IRA contribution, if that would bring them down below the 400%, and you could suddenly you could have a reduction in tax beyond what they put in the IRAs. So that was what they did. Now, but in this case, the IRS calculated the repayment and just sent a bill, an assessment, without issuing a statutory notice of deficiency, otherwise known as a 90-day letter. So the question is that valid? They went sent to you owe us, and you're now in collections. So the taxpayers in this case, what they did in this case, the IRS issued letter 12C to ask for the missing form. The taxpayers sent it. It showed they were ineligible for the premium tax credit, and they owed back over $20,000. The IRS assessed this amount immediately, right? Now, the taxpayers argued in their collection due process hearing that they were denied their due process rights to petition petition the tax court because there was no statutory notice deficiency. Now, we're going to ignore the fact that they gone to tax court to protest this, right? Had the IRS timely issued the 90-day letter, and had they filed for the tax court, had they gone to tax court, it's virtually certain the tax court would have found they owed $20,904. Nobody's questioning that here, right? They would have owed it. Well, I guess maybe they might argue, they might not have, but I'm going to suggest, but alarm bells are going off. I'm just suggesting I'd love to hear their theory about why they didn't know it. But the reality was they never got to make that argument, and the IRS had to give them that right was their argument, or it's going to agree with them. Now, what the IRS argued was that the late filed 8962 was a self-assessment, that it became the tax shown on the return under 6201, which would allow them to immediately assess, that's what the IRS does. When you send in your tax return, right, you self-report your taxes, and that becomes an assessment. Now, IRS does not have to issue a 90-day letter to allow you to take yourself to tax court over that. That's self-assessed, right? They're saying, well, that when they sent back the 8962 filled in, that was a self-assessment. That became, under Section 6201, that became the tax shown on the return. That allowed the IRS to go directly to assessment. Now, the court disagreed, right? The court looked at Section 6211. That is a deficiency, right? Since the tax imposed exceeded the tax shown in the original return, that meant the definition of a deficiency. And everybody agreed the IRS did not use the math error procedures under Section 6213B. That would be option B for this, right? So the question becomes very simply, does the post-filing reconciliation constitute self-assessment? The tax court said no. They said that this is the clear, easy, simple definition of a deficiency, for which a notice of deficiency must be issued by the IRS, and was not in this case. Right? The court called this the quintessential deficiency. Absolutely. It's just clear. This is a deficiency under the law. And because the IRS did not use their math error authority under Section 62B, if they had, they would have had to have issued a math error notice, would have given the taxpayer 60 days to go for abatement. It wouldn't have been a 90-day notice of statutory notice of deficiency. It would have been 60 days, but they didn't go that route. The taxpayers didn't have 60 days to request abatement, nor 90 days to contest in the tax court. And had a few other rights had it been the math notice errors gone down the line. They just assessed the tax. The tax court ruled straight up. The post-filing reconciliation is not a self-assessment. The taxpayers are entitled to judicial review before assessment in this case. Fair to issue the notice of deficiency means the assessment is invalid. There is no assessment of $20,904 on the table. And gang, pretty likely the statute is run on the IRS being able to go put one together now. That's a problem. Now, since the assessment was declared invalid, that is a procedural check that should have been done, in the collection due process hearing, right? When it went to basically, the officer to hear that hearing, that officer should have, in essence, gone a procedural check and found out that there was no notice of deficiency issued, and it should have been, right? In this case, if the client provides data to the IRS after filing, like in a letter 12C response that increases the tax, the taxpayer must issue a notice of deficiency unless they strictly follow the math error procedures. If they just send a bill, then you need to challenge the validity of that assessment. Now, realize, it depends on, obviously if you challenge the validity of that, then the IRS could still go and issue the 90-day letter. or issue the math error notice. That's if time's available, they can still do that. In this case, they weren't. And the court said automatically when they're reviewing a collection due process hearing, under that authority, when the officer makes just an invalid, in essence, invalidly applies law, states the law works this way when it doesn't, that in and of itself is an abuse of discretion. So they now are essentially saying, we're sending it back. Hey, IRS, except here's the problem. The assessment's invalid. With no assessment, they have nothing they can collect off of. And presumably, we also have a little problem here that, it's past the time when they could do a notice of deficiency. So again, the study of this taxpayer win. Our dispute in this case, they omitted a form that triggered the IRS to go to action saying you didn't file this form to reconcile. When they did it, the form they filled in shows that they were, they basically had $20,904 worth of advanced premium tax credit that they had no right to keep. Okay. And as I say, that's why I say at tax court, that would have been hard to overcome. But the IRS did not go the realm of actually issuing the notice of deficiency. What they did was they went straight to send us the money. Not allowed to go straight there in this case, okay? The IRS was legally obligated because they hadn't followed the math error notice procedures. It had to be a statutory notice of deficiency. This was a deficiency. Difference from what was on the return. 2 outs for that. It could be a math error. If they're going to argue that's a math error, which would have still required arguing this as part of the return. Or they could argue, they go statutory notice of deficiency and open up the 90-day letter rule, right? And do that realm and give them the right to go to appeals in that case before assessment. Like we say, the tax court ruled that the additional tax was deficiency. A deficiency is tax imposed by law minus the tax return on the taxpayer's return. Because of that, notice of deficiency was legally required and was not sent. That assessment, therefore, is invalid. The collection process is halted. And in this case, it's highly likely it can't restart. It's highly likely they're just, out of luck at this point, right? They managed to blow it at this point, right? Procedure matters as much as substance. When we're into these things, we're talking about deficiency procedures, collections, representing clients. If you remember, we got a new statement of standards for tax services in 2024 that applies to CPAs. And one of the things added there was noting that to represent clients, before the IRS, we're talking about, and under these, before the IRS, these procedural issues, if you do that work, you need not only expertise in, let's say, applying the law for the, for the premium tax credit. You need that. If you're going to represent somebody on this issue, you need to understand that part of the law and work with that, be able to, properly work with that part of the law. But you also have to understand the procedure rules because this thing is dead to rights in terms of, the technical law says they owe the money. They owe $21,000. But the problem is, did the IRS go through the right procedures to do it? And while in many cases we get these procedural arguments, with the tax protesters filings, which are dismissed by the court, virtually regularly, there are real procedural goofs that can do it. In this case, a procedural goof costs the IRS $21,000, just under $21,000. Taxpayer got $21,000. They get to keep $20,000 they really should never have gotten. That's because the government fouls up. It's the same reason why, if they had $21,000 refund coming from 6 years ago, they never filed the return. They screwed up procedurally. Yeah, the law is very simple. That they were overpaid by that much. That's fine. But you have to understand procedures because this is the other reason to understand procedures. Usually, if you get the procedure wrong, you can get a result that is totally at odds with what the actual law in the area that you're looking at says you should get because procedures are wrong. That's why procedural background is so important. Well, this wraps up the update for this week, right? Hopefully, good luck with starting your filing season on the 26th. Got a little bit of time there. I suspect we're not going to have a whole lot then, and I suspect we're going to have a lot of forms that you can't file right at that time. Keep an eye out for all those forms updates, see what happens to your software, see when you actually can file everything. That'll be key. As always, you can email me. The address you see there on the screen if you're watching the video, Zollars at CurrentFullTaxDevelopments.com. Also, I do, as I say, hang around on the Connect sites for the Arizona Society of CPAs, the New Jersey Society of CPAs, Minnesota Society of CPAs, Idaho Society of CPAs, Illinois Society, and Washington. So take a look there. If you see something, you have a question and you post it there and I see it, I may decide to see if I can help answer it. We'll go from there. Otherwise, as I said, we will see you next week here on Current Federal Tax Developments.